This is Andrew Stotz of Stotz Investment Research, and I'm going to talk to you about how a high PE means that without an earnings surge, the market rally in the US is at risk. Now, all this data is publicly available, and you'll see the website down at the bottom where I quote the sources. This is coming from Schiller and his information he has on market PE. And important thing is when we talk about the Schiller PE, we actually call it CAPE, cyclically adjusted PE, because he's looking at the PE over, I think it's a 10-year period, a long-term average of earnings. So that gives a little bit more stability rather than having ups and downs. Now I've created a table within this chart, but first let's just look at the two lines. The first line is the yellow line, and that's the US stock market going back. In this case, I just stopped it at 1949 and brought it forward to today. And we can see a pretty massive run in the recent years. And the second thing is the blue line, which is the PE. And the main thing you can see is that there was a dot-com bubble that happened in 2001 that pushed PE up super high. Now I made a table that's inside this chart to help us understand the duration of this from trough, the bottom, to the peak. And we can see that the three main runs that the market has had, which we can see in this chart in recent years, was a 69-month run, a 57-month run, and then most recently a 97-month run. So a very long run in the market. And you can see what happened to the PE in the first run, which was from December 94 to August 2000. The PE went from 20 to 43. So the market went up by 226%, and the Schiller PE went up by 115. Now the next rally that was up until 2007 was more subdued. The PE went from 21 to 27. Now it was an 84% rise in the market and a 29% rise in the PE. And the final one that we're in right now, the PE went from 13 times from distressed levels after the 2008 crisis to 30 times currently. Not the highest, but the increase in the market was 215, and the Schiller PE was 123% increase. So what can we take away from this? First of all, the PE in the US moved from 13 times to darn expensive at 30 times right now. It's not the highest, but it's expensive. The second thing is the rally was partially fueled by near zero interest rates. We've seen that before. We had near zero interest rates for almost a decade. And what I would say is that without a substantial rise in profit margins, the US stock market rally could be finished. Want more? Just subscribe to my YouTube channel, and I will see you there.